think you have the number?
130.
I'm hearing 130. I quite like 130. You've got an opening tax liability. We've got an opening tax liability of both 50 and 100. Now, if you love your T accounts and you want to, and you've done a T account, then those two entries are on the right-hand side because they're liabilities and they are credit balances. So we have an opening balance of both 50 and 150. When you have a P&L taxation charge, does this mean you owe more tax or less tax? So you owe tax at the beginning of the period of 150. You then charge your profit, debit your profit with an expense of 200. Does that mean you owe more or less?
More.
If you make a profit, does this mean that you will have more tax to pay or less tax to pay? More tax to pay. Yeah? So that's last year's liability. Then you've got an extra 200 on top. If you have paid no tax, then your liability is 350. If you have paid no tax, then your liability is 350. But your liability is not 350 because you have paid some tax. Your liability is 220. So this is 100, and this is 120, and therefore the amount of tax you've paid is 130. That is a figure in brackets. That is a figure in operating activities. If you did a T account, then you got the answer right. So I don't need to show you. If you did a T account and got the answer wrong, don't do a T account. Because you're not getting T accounts. Yeah? So to do T accounts, you need to be good with T accounts, and this is a simple example. Yeah? Right. I have finished giving you a recap. I have finished being nice to you. I have finished with F7. There are 4 new things that I'm now going to teach you about. There are 4 new things that I'm going to teach you about, but this is a number crunching question. This is about group accounts, group cash flows. So what I'm about to teach you is very small, because you know all about cash flows, you know all about group accounts, and I'm putting it together, and this is not something that you get a written question on. This is something which is, I think, examined, from what I see, examined numerically, computationally. When you do a group balance sheet, intercompany assets and liabilities are eliminated because you're wanting to present the group balance sheet as if it were a single entity. When you're doing a group P&L, intercompany sales and purchases, intercompany income and expenses are eliminated because you're wanting to show the group as if it were a single entity. When you're doing a group cash flow, we are wanting to show the group cash flow as if it were a single entity, so we're eliminating any intercompany cash flows. What cash flow every year comes out of the sub and into the parent? What cash flow, which is an intercompany cash flow, will we eliminate, comes out of the subsidiary and into the parent? What are we talking about? What every year does the subsidiary pay out, dividend, and the parent will receive that? So if I own 80% of the subsidiary, I will receive 80% of their dividend. If they pay a dividend of 200, that 200 is not in the cash flow. If I receive 160, the 160 is not in the cash flow. Hang on a minute, 40 is paid to the NCI. So something you've never seen before from an F7 perspective is dividends paid to the NCI. Dividends paid to the NCI. 2 questions for you. In or out? Out. And if you're making a payment to the NCI, operating, investing, or financing? Financing. Right. I don't think I need to talk too much more. Can you have a look at number 4? Can you have a look at number 4? Can you calculate for me the answer to number 4? Don't think it's 100. I'm hearing 100, 200 and 400. Right, let's have a look at this gently. We know the money's going out, we know it's financing activities, and we know how to basically calculate cash flows. The opening balance is 500. If you want to do a T account, respect. T accounts are fine, T accounts get exactly the same answer. NCI is equity. So NCI is on the right-hand side of your T account. Now you're giving them 700. Share of profit. Think about working for. Share of profit increases the NCI. So yeah, the share of the post-acquisition profit is increasing. This is 700. Control to control again. Control makes me have to think. We're selling them shares. So NCI is going up, plus or minus 100? Plus, yeah, the NCI is going up. So we're crediting the NCI from a control to control perspective. Yeah? So I'm imagining, therefore, that at the end of the day, this should be 1,300. It's not 1,300. You've been paying off the NCI, paying them dividends, reducing it down, and therefore the dividend that you paid them is 400. Well done. I am trying to teach you 4 new things. It's always about the reconciliation. The opening balance, the closing balance, reconciling it all through. So we've done the dividends paid to the NCI, that's one new thing. Second new thing, dividends received from associate. Second new thing, dividends received from associate. In or out? If you've received a dividend from the associate, is that cash in or cash out? Cash in. Having invested in the associate and then you receive a return, a dividend on your investment, would that be operating, investing, or financing? Investing. So the cash flow that we are calculating is cash in, which is an investing activity. Can you do number 6, please? Can you do number 6, please?